Good afternoon, Scott Riley, T3 Live. Welcome to today's recap. This is the Friday recap, the last recap of the week, and it's been a long one. This, to me, has probably been one of the most frustrating weeks that we've had since the beginning of the year. Actually, since the December 20th gap and go that you guys have heard me talk about so much. And usually when you sense frustration on our floor, I don't know if all of you are VTF subscribers, you know something's about to happen. You know that things aren't trading right. You can almost use this as an indicator, the frustration indicator, to say whether momentum's starting to leave, whether things are getting choppier, whether you have to pull back a tier or change a gear depending on what you're doing. And I've been talking about this accelerated uptrend for a good week or two, and I've shown you different angles of the increase. And the question is, what's the speed and composure moving forward? So to me, it looks like they tested the highest degree, to the upside today. And, in the back of my head, I'm thinking it could have been worse. Some things went green, some things came off the low. The upper range didn't really get broken. So I do think that market participants, including us, are a bit spoiled, where we haven't had to deal with more than a 1% pull-in for a while. So we've been holding 8 to 12 to 15 to 18 to 20 positions and riding a trend. So it's not always that easy to make money. I guess that's the feel of an investor. It's great to be able to really not do that much work, check the market, say, oh, I made money in this position, this position, this position, and usually we have to work for it. We have to trade back and forth, add a tier, take off a tier, look around, find a new trade, book a profit. Whereas sometimes you let the market make you money as well as trading, and that's been the time frame that we've been in ever since that December 20th gap and go. So if you look here at the chart of the S&P, I'm going to show you these three different trends. This is the gradual trend. This is the trend that started on that outside day back on October 4th. You live in the glory days when I said this is a day to take notice, probably one of the most important days of last year. And then right around here was when we put in the 75% chance that was the low of the year. So on a macro trade, good readjustment. Anyway, fast forward, here's your low, higher low, another higher low. So this gradual uptrend is still well below where we are now. So this gradual uptrend that held here and held here, that's accelerated higher, still is way extended. So then, come a little bit forward here. December 20th, this was your gap and go right there when we crossed above this descending channel. And that started a new accelerated uptrend. So you can look at this uptrend and, unfortunately, ascending channels tend to resolve to the downside the same way descending channels resolve to the upside. So, we'll see what happens here. So if you move along this, ascending channel, which now I'm going to take a closer look so you can see it a little bit closer, so just fast forward to where we are now. You can see that since this December 20th gap and go, we never pierced this uptrend. Okay, we came to it only really once. So if you want to take a more micro view, which I did this morning, you could see within the midst of this channel, you have somewhat of a higher channel, to be more exact. So you have this side, and then you have this side, and only once, okay, after this, red dog reversal outside day, did we come through and test it and then continue. So in my opinion, this bar looks a little similar to this one. And if you look, you haven't really seen many of these types, okay? And what we did is we still held the gap from that Jobs Friday. Last Friday, remember that? This was the Jobs Friday. This was your mini floor. Yes, we traded below both of these days this week, but we held that 1333 to 1336 level, and we basically held the 10-day. Look where the 20-day is, guys. The 20-day is at 132.25. Okay, typically strong stocks that are in big uptrend, stocks that are moving fast, they ride their 10-day. They follow their 20-day. They have corrections and they hold them. Rarely do you get situations where the indices themselves ride the 10-day and 20-day, let alone get extended from them. So if you go back to the chart and look at what took place today, people are saying, oh, is the rally over? All we did is, yes, we broke a bit of this, this 4-day momentum area, and we came in more than we've come in a while down to the 10-day. But overall, especially for macro investors, they're not even going to blink. They're just going to listen to the media and then get a little worried because that's what they do. So at least next week we have this point of reference to trade against, which is really like 133.60-ish. And if we were to get below this, the gap is filled down to 133, and then there's really no reason why we can't at least even get down to 132.26. And if we were to get down to here, if we were, not saying we were going to, it's still fine. Look where that is in the whole scheme of where we just came from. Look where we are in the scheme of this entire rally. We've had a few different shaking of the tree, during the course of this move. We came down, tested it here. This was, remember, we used those Fibonacci fancy, retracement areas. I'll do it for you real quickly. Remember when, we went from this October area all the way up to, to that peak. This was that 0.618 retracement, and we held here, which was the last line of defense. And then on this rally, we went all the way up again. Remember that one? And then what did we do? We came back and retested, again, the 61.8 retracement level. So I guess if you wanted to do this again, okay, which I'm not saying we want to do this, and from this leg of the rally, look where we just came down to. We're not even at the 0.26%. The 0.61% retracement of this would take us to the 50-day. So that would take us all the way down. And you know what that would be? That would be a retest of this descending trend line. And that would still be fine. And that sometimes happens. So don't get spoiled along the way here, and don't lose the fact of how far we came. So I'm just showing you what has happened. From here to here, we held the 61% retracement. Then we went up again and corrected. And then from here, we held the 61%, 61.8% retracement. And then from this low all the way up to about where we just rallied to, this is the level here. 0.26 or 0.20 is really the 20-day. So if we hold, even if we come here, okay, holding the 25% retracement is showing mega commitment to this rally, and even this 0.38, 0.2% retracement is still showing mega commitment to this rally, which would take us to this point of reference, which would be about 129.85. So the question is, if you come back to me, is what's your commitment? For most of us, we're momentum traders, we're active traders. This last 5 to 7 week time period, we held multiple positions, and that's been great. Once you start getting a little testy, you take it down, which we did. First, we went to having hedges with our multiple positions, and now after this day, I think we have even less positions, still with some hedges, and pretty soon I'm going to be back to just day trading, just because that's what I could do. I could be a sniper, I can make money, making cash flow, not too much risk out there, and that's primarily, my forte. And but when we get to a point where I see some type of reversal, I see a new level that I think is compelling, I'll see what's acting best. I'll use my relative strength rules, because every time we have a market correction, if you embrace it and you're not trapped in it, you see what's acting best. You get to uncover the 8 to 12 best acting stocks that when the market goes, those are the first ones to go to my go-to list, and the first ones to typically be the fast and furious stocks to the upside that can give you the most alpha and the best bang for the buck. So during corrections, if you're not caught in it and you have your eyes open, you could then figure out what stocks don't come in as much, what stocks hold up better, and what stocks we're going to be trading when we resume once again. And again, this is only day one, so we're just trying to think ahead here. So don't get upset if you messed up this week. Don't get upset if you mismanaged positions. Don't get upset if you think that you missed what is already taking place this year, because we're 6 weeks into 2012 and there's a lot of year ahead of us. So just try and take a deep breath and relax. It's fine. There are still a few good stocks acting well that deserve you to, your attention to stay long. And I'm just going to run through some stocks now, because I think you're pretty much done with me preaching and talking about the spiders. So if you go take a quick look at Apple, Apple still looks really good. Apple, this was when we were talking about getting long. This was your ad. This is when it broke above that earnings high, and look at this nice parabolic move. Today it took a deep breath. At this point, if it could flag up here, I think we get a nice trade above this 497 for a move to 500. I do, think, I take the same side as the analysts, guys. Right now, it's just price that makes it seem like Apple's expensive. You discount the cash, and you look at the 10-11 PE, it's so undervalued compared to the year-over-year earnings and revenue growth. The fact of the matter is that they need to split their stock in order to fulfill their true value. It just goes to the fact that they just ran very quickly right now. So as a trader, it's hard emotionally to grab along, especially after you sell a little early. I sold 2 days early, so I revenged it a little bit and I gave back a little money, trying for a cute short. But let it consolidate a day or two, and then I'm back on a more calculated trade to the upside. And then hopefully one day they split the stock, and then it could continue to trade, and you won't feel as edgy about trading a $495 stock. As far as Google concerned, needed a break. We talked about getting into the gap. It did. It's still holding this upper area. Let's let it go sideways. Not much to talk about there. Amazon also, going a bit sideways on a macro level. Really not doing so well here, but at least you have a lower level to trade against. I showed you the monthly chart here. If it were to break this 170 area, I think it's in trouble. And I still think if I were to make a macro call and someone put a gun to my head and say you got to be long or short this thing and come back in 9 months, I think I would be short it. So whatever that means to you. As far as Baidu, nice cash flow trade. Went negative to positive today. Sperling was all over it. The stock woke up and went through its moving average yesterday. Today you could have bought it, added through the high here, and now it's coming up to this descending trend line. But earnings are going to come out, so be careful. As far as Sina, not much to talk about here. It's still laggard. You have this little range here. I'm not going to really get into it because there's not much to get into there, except for it's, we'll figure out which way it can go if it trades above this area or below it for continuation. I do still think Qualcomm hangs in well, even though it's slow as molasses. I'm not used to this type of trade, so that's why I've been trying to hold it. If you look here, this earnings gap held. They sold it on the day of the earnings, no big deal. Remember, we took calls. That was a fun day for this stock. Managed it correctly, but I'll show you how I managed today poorly. And now it's still holding higher. I'm in probably a tier 1.5, and I'm hoping that we get a nice intraday trade for a juicy, tier 2 or tier 3 through 62, and we get a nice move to, so we could grab it intraday to potentially, who knows, and then that day 61.5 to 62, because that's typically all you get in Qualcomm. The stock has been accumulating for a while, and nice range holding above. We'll see what happens there. You look at the weekly chart, just getting above, so it doesn't seem that extended. So it should be a good hold there. As far as some of the banks got rejected yesterday at some upper levels. So if you look at Goldman Sachs yesterday, we tried to be long it. It did not work. It failed at this resistance, closing a little bit below this line. So to me, I'm not just buying the dip yet because who knows where it can go. I would say maybe we look at this spot. If you see like a tail off of 111.61, right now it failed at resistance. So it needs to prove that you should be owning it. JP Morgan, I don't know, at least I got out of my long, but I should have known that, look at this wide range bar that engulfed this 4-day move, gave you a nice short, and now it's really not that compelling either. So we'll see what happens here. We'll see what level it holds. It's right on the 20-day, and if you look here, this is probably a decent level to see if it could trade against. Here's that, here's its uptrend, which it opened below, but closed decent. So let's see it hopefully just get back above that. As far as, what acted well today? Hasbro. I'm long that on the news that it has a licensing deal with Zynga. It's trying to poke its nose through here. So we'll see if it can continue and get to the moving average. I think that maybe it continues. It showed relative strength today. Look at the green bar today while the market got beat up. As far as what else? The OAHs still hanging around. Still in there. You take a closer look here, you will see that still, you have your left shoulder, your head, your right shoulder. Here is your accumulation. Here is your add. It's diminishing a little bit by the neckline. So we're going to have to see a strong market in order to break above this for a bigger move. Well, and we'll have to have the market on our side there. I think you're in tier 1 now. Just hold it. If you've been holding it since this area, and you added your tier 2 around here, maybe get back down to tier 1. I think if you're just an active trader and you don't want to be involved, you sell it around this 128 and then see, if you could rebuy it back right around here. if you're not committed. It all depends on your time frame. Like APA wound up being a good trade this week through this price point, still hangs around. SLB, really not a good acting stock. I'll have to be honest, I'm a little disappointed. I actually sold it on this day when it engulfed these 3 days, and now I'm going to give it some time here. I thought it would be explosive when it broke above this, sort of like my Caterpillar trade way back here. When it broke above this channel, you had the channel, the lower end, the upper end. This was when it broke this descending channel. It was a really nice hold here, never came back in, which you just saw Schlumberger did, so it's a little, I would say you have to worry about it somewhat, and then it continued a lot. Then, if you recall, even the last few days, yesterday I tried to be long this thing for a breakout above this flag, but obviously it rejected it, closed it weak. So some guys actually took it home short and made money, and then you could have covered versus this support. So now I would say it's a new little pattern here. It's going to need some time. You have your low end, your high end, probably has to go sideways for a bit, so this turns into a B play. I talk about A, B, and C plays. Sometimes stocks go from the A list. This was on my A list. This was getting first in the club on my forefront. If it were to get above this area, went into the B list when it failed, and now it needs more time. So that's a whole nother educational piece about using your time effectively in the morning, what deserves to be in your A list, what gets moved to the B and the C list, and depending on what you look for, this Caterpillar is now on the B list. Schlumberger has moved to the B list. Qualcomm's still on the A list because it might be able to get through 62 and give you a nice cash flow trade. Goldman, back down to the B list. OAH's B plus list. I would say Hasbro's on the A minus list. And so that's what you look for. You look for what should have real estate on your trading screen, because there's not that much real estate there. So that's a whole lesson that I can go through, and on a Friday that's the last thing you guys need at this stage in the game. The same way when like MCP failed, at that 32 area, I sold it, stopped trading it, and it went off my list. Maybe it'll come on another area when MCP, just so you know, like it had that downtrend. They're very exciting when it breaks through, and it tried and it failed. It tried right here, right? Tried to go, it reversed that day. That was the day Sperling was all pissed off, and I said, you know what, it didn't continue. I'm out. Now look at it. Think to yourself real quickly. Look at me. Think. What else broke out, didn't hold the level, that was on the A list, made us all a lot of money, that should now be on the B minus list? I'll give you one more second. DNDN, right? It was on the radar, tight package, tight pattern, broke above 1520, gave us a great 2-day trade, then reversed. And then if you took your emotions out of the trade, the stock did a few things it shouldn't have done, and you should have just went away from it and not given too much of it back. I know Sperling's been all over it, but he made some mistakes here, and we all do. This shouldn't have happened, right? This shouldn't have came all the way back in. If this stock was really that strong, when it broke above this breakout area, right? I'll get it a little closer. It should never have came all the way back, okay? Retracement rules. If this stock was going to continue, it should really have never broke 16. It traded through, came back above, below. You're supposed to hold the top third of whatever this wide range bar was to show commitment. It didn't hold the top third, and then it didn't even hold this breakout. I was done with this thing right here, okay? I was done with it at 1520 because it showed that this breakout was invalidated. So now it's off the A list. I guess if you sold some at 1520, or you got out and you said, oh, let me try it versus this support, okay. But now it's going to need something major to get it going again, like really major. Same with like if you remember this move, it never really came back. If you want to measure the whole thing, it held the top third of this whole thing. So that's why I was able to continue. You saw strength and commitment here, big bar. And then once it couldn't hold this, you had to be a little skeptical. And then this was the day you get out of most of it. And if you did so, you saved yourself some pain. So if you take your emotions out of the trade, and I even tried to explain that to Mark, I'm like, Mark, no one did this to you. No one knows you're in these positions. I know you have a lot of it, and it shouldn't have came back down to where it came down to, but it did, so read into it. Same way yesterday, the VIX didn't go down when the market closed off the lows. So if you don't get pissed off and say, oh, I'm short the VIX, what's going on here? The markets came off the low and VIX isn't going down. It tells you something that maybe the forces of will know that something's going to happen in the future. Lo and behold, we were down 12 handles on the open, so the VIX was telling you, you know what, loosen up on some positions, maybe get some shorts, and maybe stay long the VIX because it went up, didn't pull in when it was supposed to, so somebody or some big money guy knew a lot more than we knew, so if you read into it versus getting frustrated with it, it could have given you some clues on where we were going next. So there's always clues to where we're going to go next if you're not caught in the trade, if you're not frustrated, if you're not opinionated, and if you're not stubborn in order to see what's going on here. Same way in December when the market would go lower and the VIX would go lower. The market went a little lower, the VIX would go lower. Everyone's like, the VIX is broken. The VIX is not working. Market went lower and the VIX didn't go higher. You know what? December 20th, the market gapped up and then it had a rally where it never pulled in more than 1%. So the VIX was showing you that we're going to have a big rally with very low volatility, and that's what took place the next 4 to 5 weeks. So you got to read into things. And for us that are technical traders that use price action and use rules, you know, we don't have 100 sales traders. I have a few. I have friends out there, you know, but for us that, you know, that don't know where the huge flows are going, you have to follow the technicals, and the technicals don't lie if you're willing to look at them and look at them closely, you know, without an opinion and without emotion. We embrace emotion. That's how we make money. We love volatility because we know how to manage it. So just keep doing what you're doing. You'll be fine. I know it's a long week. This week for me was a little complicated. You know, to add a little salt in the wound, I kind of had a inside feeling that LinkedIn was going to be really good. I took some calls. Meanwhile, stock was up huge today, and you know, you look at this big move above this downtrend, and you know, I made peanuts. Went to 90, went to this resistance, and I had the calls that I was out of right around this 85, and I missed the juice. So you know, what am I going to do? Am I going to cry about it? A little bit, but I'll learn from it next time. You know, once you get out of your calls, just trade the stock, because now that you're, you know, not in harm's way with the actual overnight type of scenario. That's the only reason why I take calls into earnings, because you never know what's going to happen. You never know if you're going to get a Groupon, or you never know you're going to get a Google. So this one I felt like it should be bullish, but once I sold my calls and covered my hedge there, I should have said we're getting above 85, could have played it for 4 or 5 points instead of getting away from it. So we all have a lot to learn, and it's all a work in progress. As long as you're willing to put in the work, you'll be able to make the progress and make the money down the road. It's been Scott Redler, T3 Live, the recap. Have a great weekend. See you Monday morning.